So we'd like to start now. Thank you all for joining us in the Finance Memo. Today we have Dan Rasmussen. He is the founder of Verdad Capital. Dan, thank you for joining us.
It's my pleasure. Thanks for having me.
We first would like to get to know you better and our audience. So could you tell us more about your background and how you founded Verdad Capital?
Yeah, so I graduated from Harvard in 2009. I studied history and literature, which is obviously an unusual background for someone that goes into finance. But my junior year of college, I was trying to figure out what to do. And my father is a lawyer. He said, find a job that pays you for your decisions, not by the hour. And so I started to say, well, what kind of job would pay me for my decisions? And I naturally found investing. And so I applied to a bunch of places. I ended up getting a summer internship at Bridgewater Associates, Ray Dalio's firm, which is an unbelievable experience. I learned a huge amount. And then after college, I went to work for Bain Capital, Mitt Romney's old firm here in Boston for 4 years. And I had the idea for this strategy, for the original strategy when I was at Bain. And we did a whole project at Bain looking at the historical drivers of private equity returns, and private equity has been the best performing asset class over the past 30 years. And what we found is that private equity deals are small relative to public equity investments. They tend to be very levered, lots of debt, and historically they were very cheap. So you were buying private markets were much less expensive than public markets, and you could arbitrage that by buying cheap in private markets and selling in public markets. And that was one of the core drivers of PE returns over this period. And what I've noticed is that private equity had gotten a lot more expensive and it migrated much more towards growth investing. And I wanted to go and do the value end of things. So I left Bain. I went to Stanford Business School, where I studied under Charles Lee, who's one of the great quantitative thinkers, and decided to launch Verdad. So we started. That was the original strategy: is to buy small, cheap, levered companies in public markets as an alternative to private equity. And we've since expanded from there. So we have really 4 business lines. So we have our small cap value strategies, which are small, cheap, levered companies. And then we have an opportunistic strategy where we found that there are certain times in the business cycle where that strategy does better. So we have strategies where you say, okay, buy in at this time and then sell out once that period is over. And then third, we have a strategy, a counter-cyclical tactical asset allocation approach, which we just have been developing. It's been a big focus of research here. And then finally, we have a small credit strategy focused on high yield bonds. So the business has really expanded. We launched with 8 million under management or so when I was in business school, and now we manage over $500 million. So it's been a big growth. And I'm 34 years old, so hopefully I'll be doing this for at least the next 31 years until the 65-year retirement age in the United States. So that's a little bit about my background. I hope that's helpful.
Dan, honestly, this was amazing. Growing from 8 million assets under management to 500, almost close to 100x, huge improvement in the past couple of years. So it takes us to our next question. How can a person replicate such performance in private equity in public markets?
Yeah, so I think there's, what is private equity? I think private equity, yes, you're buying private companies, you're taking a controlling stake, and you're on the board, right? And those are all sort of descriptions of private equity. But if you think about it from a more quantitative perspective, what is the strategy of private equity? What quantitatively is the economic transaction being made, and what's the economic source of the return in that strategy? And I think there are really a few just sort of distinct periods in the history of private equity. So let's call it the early 80s to mid 90s. And I think that sort of the early days of private equity, which had just astonishing returns. And that broadly was an arbitrage between very inexpensive private markets and very attractively priced public markets, funded by a new asset class, which is high fund it through the issuance of junk bonds, and then they could sell to either strategics that were publicly traded or they could IPO themselves. And the combination of those sort of innovations of being willing to buy in private markets where things were cheap, the willingness to use junk debt to finance the transactions, right? These were really innovative things to be doing, and as a result, tremendously lucrative to those early players during that early period. You had a few years in the late 90s where private equity dabbled in tech and growth. A lot of those firms got burned pretty badly. That you saw the there have been very few private equity firms that have blown up, but you saw two blow up during this period, Forrest and Little and Hicks Muse, who went big into tech. That was the wrong thing. And then you had sort of a return to private equity's roots in the 2000s, where a lot of the transactions from 2000 to 2005 were these, maybe they were getting bigger, it was more institutional, but they're still buying cheap things in private markets. They were using debt, and they were getting multiple arbitrage. And then you really saw by the mid 2000s and since this institutionalization of private equity, where everybody was saying, hey, this needs to be an asset class. You should have 20% of your endowment or 40% of your endowment in private equity, and the spigots of money just got unleashed on every private equity strategy and asset class. And as a result, purchase multiples went up. So you saw this big transformation of what had been a small or micro cap value strategy turning into a smaller micro cap growth strategy, and still being funded by lots of debt. So debt was common, small, they're still small, those things are common, but the valuation environment changed a lot between, say, 2005 and 2015. And as a result of that, private equity investors are very smart people, and they realize that, gee, if we're going to be paying these big prices in these very competitive auctions, we really can't go buy boring industrial companies like we used to. We need to go buy tech. And so you've really seen this convergence of private equity and venture and growth equity, where I'd say probably the majority of private equity dollars today are flowing into technology. The sort of old school, boring, cheap industrial type stuff is a very small minority of what's being done. And so I think if you said, hey, I want to go replicate private equity, your probably closest proxy for that is, go and buy the NASDAQ or something, right? Because that's what private equity is today. It is growth equity. It is tech focused. That's where the money in PE is being made. That's where the big funds are being raised. I think my view is that value. I'm much more value oriented, right? I think that there's a big risk. So if you think of small levered growth bets, one of the big problems, right? And if you think sort of intellectually about what tends to work in investing and what tends not to work, right? First, you're looking for high growth rates. But the problem with high growth rates is that people tend to over extrapolate. So if you look broadly over history, people tend to pay too high of prices for things that have high historical growth rates, and they tend to over extrapolate things that have negative recent growth and say, oh, they're going to get even worse. And so historically, the way to make money has been to arbitrage that by buying things with low growth expectations, selling things with high growth expectations. But what you've seen recently and what's sort of been working in the market and what private equity has been focused on is buying these very high growth names, right? And paying big prices to buy them. And I think the next thing that you have to be cognizant of in investing is the risk of ruin. And the risk of ruin can come from bankruptcy risk, right? Where the company just literally goes bankrupt and so you lose 100% of your equity, or it can come through really big repricing. So, if something was worth 30 times sales and now is worth 1 time sales, right? That looks like a bankruptcy to an equity investor, even if the company didn't actually go bankrupt. And so you want to, try to avoid that type of risk. And I think if you think about technology companies, right, there's a world of difference between Microsoft, which has no bankruptcy risk, right? Microsoft has zero bankruptcy risk, and might have overvaluation risk, but it's not extreme overvaluation risk, right? Microsoft is so big and so well understood, and the pricing isn't insane, versus some $500 million SaaS software company that's being purchased at some crazy multiple in the private markets and being funded with debt, where you've got revaluation risk, you've got bankruptcy risk, you've got all these risks, and I think that is really not understood by investors, just how risky the transactions are being done in PE today are, and just how risky I think growth investing is generally. So my preference is to go and look for value, right? Really cheap companies that are high quality, that have a real chance to reprice as people realize their intrinsic value. This is obviously a strategy that's been out of favor of late, but one that I think has a much more reliable return stream, right? Growth investing is prone to booms and busts. Value investing tends to kind of work in and out through the decades, albeit it can look horrible on a relative basis when growth has one of its big winning decades, as it has over the last decade.
Oh, well, that's a great point of view. Private equity is basically high growth tech. One thing that I really don't like about private equity is most of the funds are leveraged and they are not mark to market. So it would seem that they are not as risky as buying leveraged stocks, but they are. So that's another problem I see with them. Now, your last point takes us to our next question, which is your high yield spread, your indicator. How would an investor use that indicator?
Yes. So the high yield spread measures the difference between the borrowing costs of below investment grade companies and U.S. Treasuries, and so it's basically the marginal borrower, right? The company that's it's not Microsoft or Walmart who can borrow money whenever at the prevailing rate. It's companies whose always have to pay a premium, right? They're a little more risky. They have to pay a premium, and the lenders are looking at those companies and they're saying, I don't know, should I lend to them or not, right? The marginal borrower. And that marginal borrower is important because that really drives economic activity, right? If you're a marginal borrower, right, you're an industrial company, you're thinking about building a new factory, but you can only put down 20% of the money, you're going to need to borrow 80% of the money for the new factory. Well, it really makes a difference to you whether you can borrow at 3% or 7%, right? And if borrowing costs are at 7, you say, gee, I don't know whether I can build this factory. Well, then you don't hire the construction workers to build the factory. Those construction workers don't go buy jeans at American Eagle, right? And there's this feedback loop into the economy. And so looking at and thinking about the world from a credit-driven perspective is, I think, a very central shift for investors, right? I think you've got to think about most markets are credit-driven markets. Think of U.S. housing, right? U.S. housing prices, U.S. housing purchases are financed the majority with debt. Therefore, the cost and availability of that debt is one of the prime determinants of the prices of those homes. And in turn, the prices of those homes is a driver of credit availability, right? Because if a bank is saying, hey, I want a loan at a 50% loan to value ratio, well, if the same house is worth 20% more, that bank is going to lend 20% more because they're looking at the valuation of the house and determining how much credit to lend. And so you see this feedback loop between asset prices and leverage that I think is the key to understanding broadly how asset markets work. And what's true in housing is also true in private equity, which is debt financed. And it's true in the construction of new projects, and it's true in all sorts of ways about our broad economy. And so what I think of trying to, and when we talk about international and emerging markets, because there the liquidity metric is not necessarily the high yield spread, it's actually the dollar, the value of the dollar is the key sort of measure of global liquidity and cost of borrow, et cetera. But within the US and within developed markets, I think the high yield spread is the best proxy. So I think there are a variety of ways to think about this, right? I think when spreads are very wide and borrowing costs are very high, you're generally in some sort of economic crisis. And economic crises represent unique buying opportunities. And we've written a whole paper on this that I can go into more detail on. Conversely, when spreads are tight, like they are today, there are many more things that can happen than will happen. So when spreads are tight, there's often inflationary pressure, but not always. There's often bubbles that form, but not always. There's often, robust growth in certain sectors, but not always. And I think, in my view, you want to be more diversified when spreads are tight. You want to be more concentrated when spreads are wide. And I think the direction of spreads can also provide you with some instinct about what's going on in the world, right? When spreads are tightening, that tends to be stimulative for GDP growth, right? Lower borrowing costs are good for the economy. And conversely, rising borrowing costs tend to be, put downward pressure on GDP growth. And so I I think very broadly, thinking about credit markets, both the level and direction, right? Are borrowing costs high or low? Are borrowing costs trending up or trending down? And I think that a lot of these intuition, right? I think people are used to thinking about this in terms of interest rates. When interest rates go up, or when interest rates are going down, when they're high, when they're low. And in my view, it's not the interest rates that matter; it's the spread over interest rates, right? It's really the cost of the marginal borrower is what really matters, not what the government borrowing rate is, but much more what that actual received borrow cost is for the actual marginal borrower, these sort of risky companies. And so I think that credit-driven view of the world is very central to how I invest and how I think more people should invest, because you're focusing on one of the fundamental drivers of what's going on in the economy.
Great answer, Dan. This takes us actually to our next question, which would be more of a macro aspect. We would love to know your opinion about what's happening with inflation. Is it transitory, or is it here to stay? This is a huge discussion. We'd love to hear your input.
Yeah, so I think part of my answer is I don't know. I think we'll have to wait to find out. But I think regardless of whether it's true, I think investors need to be much more cognizant about the impact inflation can have on their portfolios, and they need to be hedging against inflation. It is absolutely essential, right? This is probably the most serious inflation risk we've had since the 70s. It might turn out to be transitory and it was a false alarm, but it might not. And inflation can have such an impact on your portfolio that if you're not prepared, I think it's very risky. So what does preparation for inflation look like, or how does inflation impact portfolios? One of the big problems with inflationary environments, is that traditionally investors think of stocks and bonds as being negatively correlated. And thus a traditional 60-40 portfolio, 60% stocks, 40% bonds. When stocks do well, the bonds do poorly. When the stocks do badly, the bonds do well. When there's inflation, inflation can hurt both the stocks and the bonds. And so you look at a period like the 1970s in the US, stocks and bonds returned zero for a decade. Both of them returned zero. And there was a positive correlation between stock and bond returns, right? And so what should investors have done in the 70s when there was inflation? Well, the answer is to buy commodities. Gold, oil, copper, right? Those types of commodities did extraordinarily well and tend to do extraordinarily well during inflationary periods. Now they do terribly, a lot of them, when inflation is when there's deflation, when they're but they do really well when there's inflation. So I think that in preparing for an inflationary environment, investors need to be looking to be long commodities. Now that's easy for people in Saudi Arabia, but for people that don't live in Saudi Arabia, I think, and especially for investors who are looking at to divest from fossil fuels, right? The pressure to find some way to get long commodities, I think, even more intense, because it's so important to protecting your portfolio in inflationary environments. I think there are other things that you can do to protect yourself in inflationary environments, right? Inflation can often contribute to more volatile stock markets, and what do you want to do in a more volatile stock market? Some tools like trend following, which helps to mitigate drawdowns, or can be very effective, and small cap value, which tends to do very well in periods of macroeconomic volatility, is another key tool that investors should be thinking about. So I think regardless whether inflation is transitory or whether it's long-lived, it is incumbent upon all investors to be thinking about, is my portfolio prepared for inflation? Or have I built up a portfolio that's way overexposed to deflation, or that doesn't have any allocation to commodities or other inflation-sensitive assets, and I'm going to have the potential to kind of get screwed, like a lot of investors did in the 70s, by not being prepared.
I think this year just showed how oil can be a good diversifier, especially energy stocks. And the trend with ESG is the exact opposite. So I think those guys need to reevaluate.
And I think I think that what's sort of interesting, and this is a debate that I've been sort of having with a few folks here internally, right, is that there's a very normal part. So what's happened this year is in part very normal, right, which is when growth recovers from a recession. And COVID is a weird recession because the recovery was so fast. Demand is picking up ahead of supply. And so you tend to see inflation, natural inflation, across a variety of different asset classes. And so it's very normal to see a huge recovery in oil prices post-recession, right? As demand comes online, but supply hasn't yet recovered. And, you know, nobody was investing in a lot of new drilling in March of 2020, and it takes time. And so supplies get depleted, right? I mean, that's just like textbook what happens in an economic recovery, right? But I think where a lot of people are saying, well, this time might be different, is that there's been such a large move from an ESG perspective to actually reduce supply. So in the U.S., you know, you've seen the Biden administration cracking down on shale drillers. And I know that's music to some folks in Saudi Arabia's ears who aren't a huge fan of the shale industry for obvious reasons. But you know, you've seen a constraint on supply. Forget politics. U.S. investors have soured on shale. So people have lost so much money in U.S. shale that I think they say, hey, I'm not funding you to go drill more wells. Like, you got to be kidding me. You've burned all of your credibility. Just generate some cash flow first. So there's just not a lot of new drilling coming along. You know, there's a lot less than you would have expected. And then you see internationally, I think a lot of non-economic pressure to take, you know, fossil fuel type production facilities offline or divest from new, you know, production or drilling. And the question is, could that create a supply shock? And supply shocks, so that sort of demand-based recovery in oil prices has tended to be very good. Right, it's tended to coincide with rising equity prices, recovering growth. It's tended to be just a good sign, right? Like, oil is the lifeblood of an economy, and so when you see rising oil prices, what that means, the economy is doing well. On the other hand, when supply shocks happen, like they did in the 70s, that can be very detrimental, because now all of a sudden, you know, the price of a key industrial output is, you know, outpacing or putting downward pressure on demand because it's just gotten too expensive, and so it actually can have a negative impact on growth. And that's really the bad scenario that you're worried about. I tend to think we're just in a demand recovery phase, that this recovery in oil prices is just normal. But I think the minute we start to see that it's more of a supply-based problem, I think then you start to really get worried, and get more worried about inflation and some of these other things that you know, those can be really powerful stagflationary pressures when the oil supply shocks happen.
You mentioned small cap value. I think you're a big proponent of small cap value. Correct me if I'm wrong. And the vast majority of quants would agree with that. So why has the past decade been so bad for small cap value in relative performance? Is there a fundamental reason, or is it arbitraged?
Yeah, no, it's been, I mean, I think it's been a real interesting journey for me as a young person, right? I mean, I think you do all this research and you say, wow, the argument for small cap value seems so unimpeachable, right? The long-term returns have been phenomenal. And I think the intellectual framework makes a ton of sense, right? You're looking for, in small caps, you're going to find more inefficiency, and then value just makes so much sense, right? And then you say, okay, well, you know, what if I use some clever tools to filter out the bad value stocks and just like the high quality value stocks, you know, gee, aren't like, I've constructed sort of the perfectly most logical investment strategy. And then from 2018 to Q1 of 2020 was the worst period for small cap value performance ever on record back to 1926, which capped off a pretty mediocre decade for the asset class. So you sort of have to step back and say, hey, I went into small cap value because the returns had been phenomenal, and two, the logic made sense. And now I've just been a period where the returns were awful, and I'm trying to reevaluate whether there's something wrong with the logic, right? What did I miss? What did I get wrong? What's been happening? And so I think it's very important to reflect on that and to try to diagnose what went wrong, and is it something that sort of is going to be recurring and should scare us away from small cap value in the future? What lessons can we learn? And I think there are a few things to sort of acknowledge and understand about small cap value. I think the first is that small cap value works best in times of crisis. So when you really make money in small cap value is buying it in the middle of a recession and then the first few years of an economic recovery. In other words, small cap value is very GDP linked. And if you think about the 2010s, you didn't see many recessions, right? In fact, the only really recession you had in the US was COVID. And so you had a long period with no recessions. And thus that period where the macroeconomy dived and you were able to buy small cap value and then earn those super premium returns for doing it just never happened. So there's this macroeconomic aspect to low macroeconomic volatility, not many recessions, creating a difficult environment for people to make a lot of money in small cap value until COVID, right? Where you were presented with this great opportunity to earn super premium returns in small cap value. And that's been making up for a lot of the bad returns historically, but you needed to wait a long time for that to happen. The other thing is that small cap value tends to be GDP linked. And if you think about the fears over the past decade, or what was going on with GDP growth, right? What you saw is that the sort of quote unquote real economy, manufacturing, industrials, was doing relatively poorly. You had sort of secular stagnation, mediocre growth outcomes that were disappointing. And thus these GDP-linked cyclical companies, auto parts companies, manufacturing companies, et cetera, that comprise a lot of the small cap value world, were really having trouble doing well. And so the negative forecasts that were baked into their valuations were often being realized by actual results as a result of this sort of stagnant economy. And then on the other hand, I think, because what really is abnormal about the last decade isn't necessarily that, small cap value returned 10%, which is kind of normal, but that large cap growth returned, close to 20%. And so small cap value looked horrendous in comparison. So what happened that drove large cap growth to do so much better when typically large growth does relatively poorly? And that's also sort of an easy one to answer. It's that large cap US technology firms have done phenomenally, right? We've been actually through a technological revolution that has driven a massive, massive increase in corporate profits for a select set of large technology firms that were able to capitalize on this transition to the cloud and software as a service, et cetera. And so, large growth typically loses because the growth rates disappoint relative to the high expectations that are baked into the stock prices. But here, year after year, Microsoft, Facebook, Amazon, Netflix, Google's earnings came in above forecast, right? So, so the stock kept re-rating upwards as a result. And I think if you then stop and say, well, where are we today? What do we sort of project going forward? I think small cap value as a result of the last decade is pretty cheap relative to history. So it's quite attractively priced. It's one of the only global asset classes that is attractively valued, especially internationally in places like Japan that are really, really cheap. And on the other hand, large growth is priced at very extreme levels, right? Because it's one in terms of valuation. The valuations of these stocks have gone up. It's one on earnings. And it's hard to imagine what would change about that, right? Like you just sit here and say, what would happen that would make Microsoft go down 50% or Amazon go down 50% or Google go down 50%? That's hard to imagine, right? These companies are so big, they've been so successful. It's hard to make the short case. And I think you have to have something change, some surprise, something that makes that risk salient, where all of a sudden people say, I see how Microsoft could be down 50%. I see how Google could be down 50%. I see how Salesforce could be down 50%. And whenever that event happens, whenever that news event happens, that changes the paradigm through which people think about large cap tech, that's the moment at which you'll see a big reversal in those trends. But again, it's an unknown. I couldn't tell you what's going to cause that or what the most likely trigger might be, or if it'll even ever happen. But I think that's what's required to make a big shift in the large cap growth winning streak.
I wanted to ask you more about the industry. This is more of an industry-focused question. In terms of investing approach from Verdad, in comparison to Carlyle or one of the huge PE firms, what differences can you talk about more to the regular investor?
Yeah, so I think in terms of our equity strategies, there are two things that we have in common with a Carlyle or a Bain Capital or Blackstone, right? The two things we have in common is the size of the companies we're targeting. So generally we're targeting companies that are about the same size as Blackstone or Bain or KKR will be targeting, right? These are companies with, that might be valued at somewhere between, call it 500 million and 2 billion or 3 billion. And, occasionally they'll do something bigger than that. And occasionally we'll do something bigger than that. But that sweet spot is in that small cap space. In fact, we might these days be even targeting companies that are a little bit smaller in the sort of micro cap space that might be, worth 300 So, but generally size is a big thing that we have in common with private equity. The other thing we have in common in our equity strategy is the use of leverage. So we think that buying companies with debt is a pretty sensible idea. Companies that have debt on the balance sheet that can pay off that debt enhances equity returns. It magnifies the impact of multiple changes. There are lots of good reasons, as long as you can avoid bankruptcy risk, which we think there are very smart and simple ways to do. Using debt to enhance returns can be a very good thing. So in that, we're again very in common with PE today. Where we're very different is on valuation, and therefore what types of companies we're targeting. We used to be, what we do is what Blackstone and those other funds all did from like 1980 to 2005, right? Like if you look at Blackstone 4, which is a huge winner, one of their best funds ever, the best performing investments in Blackstone 4 were things like Celanese, right? This like boring chemicals company that was like 7 or 8x. Because they bought it so cheap and so levered, and then the cycle turned, they were able to sell it for a ridiculous price, right? That's what made them win in those earlier. That's the type of thing that we're doing to win today, right? Going and buying these cheap, out of favor, old world industrial companies, et cetera. Our strategies were paying 6, 7 times EBITDA for businesses. Now, if you go to what private equity is doing today, what your Blackstones or Bains or KKRs are doing today, right? They are very technology biased. They're paying 16, 18, 22 times EBITDA to buy, vertical software companies that are in the cloud, or trying to, build platform companies around that. And their interest in or excitement about doing deals at 5 or 6 times EBITDA on industrials has really, other than maybe Apollo, who specializes in that type of thing, it's really gone away. And so today, when you think about private equity and what you're buying, you're really buying large, you're buying small cap growth exposure. Whereas what we do is very, again, value oriented.
We want to shift gears a little bit. I wanted to ask you about markets outside of the United States. So I've been looking at Europe, and it looks a little bit cheap until you look at the sector makeup. It's actually more expensive than the US if you look at tech companies there. But the UK market is just cheap on every metric I've seen. So have you done any work on the UK market, and what are your thoughts?
Yeah, I think that's exactly right. I mean, I think that, broadly the developed European market is not necessarily cheaper than the US, especially on a sector matched basis. But I think there are 2 places within Europe that are very cheap. The UK is very cheap. And then emerging Europe is cheap. So if you're willing to go to Poland or Ukraine or Italy or Spain or Greece, right, those are very, very cheap markets. But your Norway, Switzerland, France, Germany, Switzerland, right, those markets are priced a lot like the US today. So I think peripheral Europe and the UK, very attractively priced, great opportunities. I think also I would say, you can't talk about international value without talking about Japan. Japan is so extraordinarily cheap. It's cheaper than it's ever been. And there are lots of reasons why people are worried about Japan, which is why it's cheap. But that is today, if you are doing quantitative value, you are, laser focused on Japan, or have to be, because that's where the vast majority of the cheapest companies in the world are today.
We've heard a lot of mixed opinions about Bitcoin. So my question, I know it's a bit of a big conversation these days. We've been hearing from Warren Buffett, 2018, rat poison. We've heard a lot of institutional investors shifting towards Bitcoin. So we would love to hear your opinion if it has a place in your portfolio.
Yeah, so I think we are very data driven. So we like large data sets. So I'd say one of the problems, the way we approach the world is we're not well suited to deal with innovations. And I think part of that is prudent, right? You say, well, gee, having very large data sets provides you some security of knowing how things are done over long periods of time, and you sort of know what you're buying better. Bitcoin is so new, it's very little history. There's not a lot to know. I would say one of the things we do know is what it's correlated with. How does Bitcoin trade? What does it relate to? And thus, what type of investment broadly is it? And then say what Bitcoin trades most closely correlated with is sort of extreme small cap growth stocks. It doesn't trade very highly correlated to something like gold, right? So I don't think it's an inflation hedge. I don't think it trades like a currency. It just doesn't. It's way too volatile. It trades a lot more like Tesla, right? For example, than it does like gold. And so I think you should think about it in your portfolio as part of that same sector of bets. To the extent that you believe in, technological revolutions and you want to bet on that, and you want to do that in small cap growth through these speculative investments, that's the part where Bitcoin fits in. Now, as data-driven investors, we'd say, generally small cap growth investments and generally betting on technological change has been a loser for investors over long periods. But it's a part of the economy that's prone to big bubbles where huge fortunes can be made. But they're often followed by big busts. And so I think, thinking about something like Bitcoin, timing is very important. When you get in, when you get out. And I think probably the lesson for most investors over the last few years is the minute you hear someone smart say bubble, buy whatever it is they say there is in a bubble and hold and never sell, because that's been basically the right strategy since about 2015. And conversely, the minute you someone say something like, wow, that looks really cheap, we should buy it, run the hell away, because that's been the worst performing thing you could have done for the last 5 years. So I think investors have been trained to gravitate towards speculative investments and to spurn value-based investments based on the results the last 2 years. I think the broad sweep of history suggests that there are 5 or 10 year periods where we go through these boom cycles and inevitably they're followed by a bust. And so I think the prudent thing to do is to avoid those types of investments. But prudence doesn't always win races in the short terms.
Bitcoin, I think many people won't take it seriously or understand it. And I think the best way to deal with that is buy Bitcoin and apply a trend following model.
I think trend following is such a smart way to think about investments like Bitcoin. I think that's right.
Just buy and only sell when it's going down. You spoke before about the 60-40 portfolio and how it's not negatively correlated as many people would believe. So what are the ramifications of that? How can investors invest better than the 60-40 portfolio, since many are saying that it might not be a good asset allocation in the future?
Yeah, so I think Bridgewater really pioneered this 4-quadrant approach to think about investing, right? That there's rising growth, falling growth, and rising inflation and falling inflation. And those 4 quadrants are what drive economic outcomes, right? And then you can think about different asset classes and how they're linked to those different forces. So stocks are very growth linked. Equities do well when growth is accelerating. And conversely, equities do poorly when growth is decelerating. Fixed income, on the other hand, is inflation linked. Fixed income does well when there's deflation and poorly when there's inflation. And so if you think about a recession typically is accompanied by both falling growth and deflation. And so bonds do really well in most recessions, and conversely, equities do horribly. So if you're thinking about what's sort of the point of a 60-40 portfolio, that bond portfolio is insulating you in those quadrant 4 falling growth, falling inflation environments, right? And then you want your equities, because in rising growth environments, equities are going to be the huge return driver in your portfolio. The problem with the 60 portfolio comes when you have rising inflation, because in rising inflation, and particularly falling growth rising inflation, which is an economic environment that's historically been about 20 to 25% of macroeconomic environments, you see both stocks do poorly because growth is down, and bonds do poorly because inflation is up, and your 60-40 portfolio doesn't work. And so Bridgewater's innovation, you can think of this as sort of the risk parity approach, is to say add commodities, right? Because commodities do very well in rising inflation environment. Now, I would say there's a bit of nuance to that. Commodities, there's a lot of different commodities. So let's broadly break them out into growth sensitive commodities, the biggest of which are oil and copper, and growth insensitive commodities, which is really the precious metals like gold. If you think about rising growth, rising inflation environments like we're in right now, right? Oil and copper are going to do very well, and gold is going to do very poorly. Conversely, if you're in a falling growth, rising inflation, a sort of stagflationary environment, historically, oil and copper have done very badly, and gold has done very well. And so in my mind, using the high yield spread or some other indicator to understand where you are in that macro framework, and then allocating strategically to gold or oil and copper, I think is very beneficial to a portfolio and insulating you from inflationary pressures. And I think, again, that's a very important topic for people to be thinking about today. And I think there are other tools. You mentioned trend following, which can be, I think, very additive to a portfolio because they have such a powerful impact in reducing vol. And so I think incorporating trend following, I think incorporating some strategic use of commodities, these are very helpful things from an asset allocation perspective.
This takes us down to our last question. Wael, did you wanted to say something? Okay, so in terms of our last question, a lot of people in the Middle East started investing with COVID, March 2020. So we would love to hear more about just general advice from you towards them.
Yeah, so I think that very broadly, for new investors, the most important thing to remember is that we as humans are biased to project forward recent experience. And so the thing that's most salient in our minds is what's happened most recently. And this is like deep biological, evolutionary biology, right? Like if you've been going to the water hole every day and you see a tiger at the water hole yesterday, you're very prompted to say, I probably shouldn't go to that water hole again because there's a tiger there, right? Whereas, if someone else said, well, there was a tiger at that water hole 5 years ago, you sort of say, well, that was 5 years ago. I don't care. I haven't seen the tiger there, so it's fine. And so we're wired to prioritize recent experience in our head and to extrapolate that forward in our decision making. And so for someone who's just started investing since COVID, right, they're going to say, wow, the things that have worked since COVID are the things that always work, and the things that haven't worked are the things that never work. And I think the first, in my mind, the next step is to say, well, gee, actually, there's a lot of data out there, a lot of historical experience. I might not have lived through it, but it can be very relevant to what actually happens in the future in markets. And I should look at that and try to understand history so I know what the possibilities are. And then I think the next step, and where I've really focused my research is to say, what are the drivers of history, right? And I think in terms of economic history, it's growth and inflation. How growth and inflation impacted asset class returns historically. What have been the different combinations of experiences that people have had? How has that led different asset classes to return over time? What's that done to investor portfolios? And then trying to find things that would have been robust to a whole variety of different potential outcomes, because the future is so unpredictable and so uncertain. And probably the one thing that we can be sure of is it's not going to be like the recent past. But we might find in history some lessons to be learned about what it could be like and help us broaden our sphere of potential thinking. And that's why I think that having some element of diversification is obviously very important, right? Thinking, do I have exposure to value? Do I have, if I'm a growth-oriented investor, I have some exposure to value. I know that interest rates are low, but maybe fixed income could play an important role in some part of my portfolio, right? Or, I know a lot of people are saying ESG this, ESG that, but gee, oil has traditionally provided a really good, played a really good role in a portfolio over time. Or gee, I know that everybody says Bitcoin is the new gold, but maybe the old gold could be useful. And I think thinking about your portfolio more broadly and asking a broader set of historical questions, I think is, in my view, the right way to make intelligent long-term decisions about investments.
Well, that's a great answer, Dan. This was a great interview. Thank you for joining us, and thanks for all the listeners. I hope you all liked this interview, and if you did, you can like this video and share it to someone who might find this useful. Thank you all. See you next time.